Hi, I'm Jackie Benson, an economist with Wells Fargo. I'm joined today by my colleague Charlie Dougherty to discuss our latest economic outlook. So Charlie, we've made some changes to our forecast since our last monthly economic outlook. We're still expecting a recession. However, we now look for it to materialize a little later toward the end of the year. And we're also expecting a slightly shallower drop of about 0.7% decline in real GDP from peak to trough. If realized, that would be pretty mild in terms of prior US recessions. So maybe you can start by explaining what the impetus was behind those changes we made.
Yeah, so the economic data are coming in on the strong side. So you have the housing market that's perking up. There's a wave of new manufacturing projects that's boosting non-residential construction. Consumers are still going out there and spending money. But the labor market has been really strong lately, and that has underlined the strength that we're seeing in the rest of the economy. So for example, in May, the US economy added close to 340,000 net new jobs. That blew past consensus estimates, and that furthered a string of pretty solid job growth. So the labor market is strong, and that is why we pushed back the timing of the recession. But we did leave the recession in our forecast, and the reason is there's still a lot of weakness in the pipeline. The economy probably hasn't experienced the full impacts of the 500 basis points in interest rate hikes that we've experienced over the past 12 months or so. Add on to that, there's been a strong tightening in credit following the banking sector volatility that we've seen recently. And then you have inflation, which has come down a little bit, but is still running at a hot pace. So Jackie, what is our outlook on the inflation front?
Yes, Charlie, like you mentioned, consumers have experienced relief from receding inflation. If you look at what the Fed cares most about, which is the core personal consumption expenditures price index, that's significantly lower than the highs experienced in mid-2022. However, it's still a far cry from the 2% target. And we do expect that that ride back to 2% is going to be slow and bumpy, especially considering the strong run of economic data that you talked about. So how do you think the Fed is absorbing all of this information in their decision making?
Yeah, well, this does represent a challenge for the Federal Reserve. On the one hand, you have economic data that continues to come in strong. On the other hand, you have inflation that is still well above their 2% target. So what we think is bound to happen is that the Fed probably goes with another 25 basis point hike at some point. So right now the Fed funds target rate is between 5 and 5.25. We think the terminal rate ends up somewhere between 5.25 and 5.5. Now, once you get to that point, as I mentioned before, the Fed probably wants to see the full impact of all of the interest rate hikes they've already implemented. So they're probably going to keep interest rate hikes on hold for the remainder of the year. But once the economy does start to experience some material weakness, once the labor market starts to deteriorate a little bit, that's when the Federal Reserve will probably start to cut interest rates. So that probably doesn't happen until the second quarter of 2024. Now, once the Fed does start to cut, they will probably go pretty quickly. So in our most recent forecast, we have the Federal Reserve cutting by 250 basis points over the balance of next year. So the Fed, it still probably has another additional rate hike in them in order to tame this persistent inflation that we're seeing. But overall, we're probably closer to the peak in terms of the Fed funds rate.
Thanks so much for that great insight. And from all of us at Wells Fargo, thanks for tuning in.